I'd like to welcome everyone to the third webinar of the Orion Private Wealth Management series. We started with global equities, and last month we gave a presentation on Australian equities, and the feedback was very, very positive. So for all of those that provided some comments, it's greatly appreciated. And we thought it was fitting that we look at the next asset class being Australian property. The format of the Zoom has been working exceptionally well, and given that the Victoria has announced over 300 new cases today, we might be using this format for some time to continue. As far as property is concerned, I think it actually stands out as quite a different asset class to the other asset classes, for the reason that people are far more directly and personally connected to property as an asset compared to other asset classes of international shares, Australian shares, cash and fixed interest. Number of clients are business owners and have either property holdings or leasing for their businesses, and obviously very interested in the direction that takes. Many people are either purchasing or considering to purchase properties in their portfolios, which may be inside or outside superannuation. And of course, I don't think there are too many people that aren't interested to have a broad understanding of where their ownership of or the value of their own residential property is going. And even though we don't generally buy and sell the principal residence on a regular basis, it's certainly one that people take an interest in tracking, and it does have an impact on people's sense of wealth, and it does ultimately then influence some of their investing and spending habits. Today we're very fortunate to have join us to present as the key speaker Mark Mazzarella, who is the portfolio manager at APN Property Group. Mark joined APN in 2014 and is responsible for Australian and global REIT analysis and funds management. Prior to joining APN, he worked for Ernst & Young for 4.5 years as a senior consultant with a variety of different responsibilities, including market research, property valuation, and due diligence and bespoke advisory engagements. Interestingly, Mark has worked across all major real estate sectors, including residential, commercial, retail, industrial, and social. And as part of his work with Ernst & Young, was selected for a 6-month secondment to work with the finance team in Singapore. Mark holds a Bachelor of Commerce and Bachelor of Property and Construction from the University of Melbourne, and is an associate of the Australian Property Institute and a certified practicing valuer and a CFA. So very, very well credentialed, very impressive experience and also qualifications. And Mark, thank you very much for being available to speak to the clients today. Before I hand over to Mark, just a couple of housekeeping points I'd like to mention. There is a questions tab at the bottom of the screen that you should see on your Zoom. If you have any questions that you'd like to ask, please type it into that questions box, and we'll seek to address those at the end of the formal part of the presentation. The presentation is being videoed, so if you wish to review it again, it will be on the website, the Orion website, late this week or early next week. And for those who are participating in the live video, there will be a questionnaire that will be emailed to you. Your feedback is greatly appreciated and helps us shape the presentations to give you the most up-to-date and informative information that is available. Before I hand over to Mark, I would like to just acknowledge a few people. First of all, Simone Newman, who is my account manager at APN Property Group, a very dear friend and very strong supporter of Orion Private Wealth Management. Simone, thank you so much for facilitating today's webinar. It's greatly appreciated. Martin Craig of MJHC Legal, who I've got a very, very long-standing association with. He's attended all the presentations, and thank you very much, Martin, for your ongoing advice to clients and support. Paul Griffiths, my account manager from Centrepoint Alliance, a very dear friend and great supporter of the practice. Thank you very much for making your time available again today, Paul. And Rajaniri from LPA unfortunately have another commitment, but did send in their apologies. They've attended the other presentations, but weren't able to join us today. All right, Mark, well, I'll hand over to you now, and thanks again for your time this afternoon.
Thank you very much, Ben, and thanks so much for the introduction. First off, good afternoon to yourself and your clients. It's an absolute pleasure to be invited onto your webinar today. I hope yourself and everyone gets something out of it, and we hope to scratch the surface on what's happening in the commercial real estate markets, with a focus, of course, on COVID-19 and its implications. But, you know, before I get into the presentation, just firstly, on behalf of everyone at APN, we hope that yourself and your clients are all keeping healthy and safe at the moment. And, you know, we wish you and your families all the best, and I really hope that we can all get through this difficult time together by doing you know, all the right things. So I guess moving on, today's presentation, I'll basically hope to give a bit of an insight into how COVID-19 has impacted the Australian commercial property sector, with a particular focus on how the pandemic's lockdown restrictions have transmitted across to the domestic real estate investment trust market. For an asset class like commercial property, where its ongoing investment return is, you know, inextricably linked to the ability to utilise the physical space, lockdown restrictions have obviously had wide-ranging implications across every one of the major sectors. So from office to retail to the local pub to your childcare centres, storage facilities, petrol stations, basically every single asset class has been touched in some fundamental type of way. Obviously, as we all know, public markets reacted almost instantly to COVID-19. It was definitely swift and a bit of a shoot first, ask questions later type mentality that we saw reflected in the equity markets volatility. So we'll have a bit of a look at how that sort of manifested into the REIT market and the broader equities market, and how things have bounced back from their lows of March as well. And we'll also touch on, for each sector, you know, the immediate cyclical and of course, perhaps potential for more structural implications as a result of COVID-19, particularly around lockdown restrictions in the short to rolling ongoing terms we're seeing in Victoria in particular, but perhaps more structural issues as well as to how we utilise physical space. So I'll also briefly touch on our flagship AREIT fund, which is the domestic property securities strategy for the Australian REIT market. And then hopefully at the end, you know, we should have a fair bit of time for Q&A. So I encourage you to send any through to Benjamin, and we'll get through those towards the end. But I guess just moving on to the next slide, I'll briefly touch on our firm, APN Property Group. I'm on slide 4 at the moment. Basically, we're a specialist real estate investment manager, and commercial property is all we do. The company was established in 1996 and has been managing real estate portfolios across the publicly listed equity security space for the last 23 years. Moving along to the next slide, as you can see, you know, our investment philosophy is one of commercial property for income, where our active approach to investing in real estate securities is resolutely focused on the belief that prioritising the sustainability and security of income across our investment process is paramount. I guess basically, we believe at its very core that commercial real estate investment should be one where the majority of long-term returns are underpinned by income. So that's rent receipts derived from both corporate, government, smaller tenants across each of the major asset classes. And that, as a result of our domestic and regional real estate securities strategies, we're trying to provide a consistent and relatively high level of income while focusing on minimising risk in the form of the standard deviation of returns. So that's a bit of an overview of APN. We'll just move on to the next slide. Lockdown and commercial property. Look, fair to say life changed dramatically in a very short period of time, as we all know. Within what felt like weeks, our knowledge of COVID-19 seemed to develop from, a bad case of the flu overseas to full-scale pandemic. We're in lockdown at first. It was a ban on work and travel, and a preference for virtual meetings and presentations like this. But that pretty much developed into, the whole gamut of hoarding toilet paper at the supermarket and the realities of living in lockdown. So I guess at this stage, the realities of an extended hibernation were largely unknown, but I guess now much better understood. Even as we grapple with the prospect of, these rolling type lockdowns, it definitely feels like everyone's, I guess, on the same page and there is light at the end of a tunnel when cases sort of decline and things can open up again. So I guess that's encouraging. What we do know is that along with most every other sector in the market, once our economy, commercial property was definitely disrupted by COVID-19 and the use of social distancing to fight it. And that just comes back to basic utilisation of real estate. So I guess lockdown as a response to COVID-19 cases, to where it all began, cases were growing and the curve was steepening. The chart on the right is one where we're looking at daily, and to see the velocity of new cases and the rate of spread, you can see on the right there that the cases flattened after the initial spike, and where they were doubling every 7 days on the left, as they'll show, but it takes a bit of time for that curve to flatten. But the number of cases hit a wall, and nationwide lockdown restrictions were well set and then begun to lift, as we know. But on to the next slide, having a look at, I guess, what happens when you hit pause on an economy, on livelihoods and on activity. So I guess in how businesses were feeling about investing and people were feeling about shopping on the left and right charts, basically horrible. You can see the business confidence and consumer confidence around capital expenditure activity, as well as the willingness to spend, basically reverted to pre-GFC lows in a very, very short space of time. And that's as at the middle of March type figures there. Obviously, what happens when you hit pause onto how people were physically moving about, we effectively weren't and had no idea when that would change, and that definitely added to anxiety. Mobility levels across all that major modes of transport basically cratered. Transport usage was down dramatically, and the chart on the right, movement across Sydney and Melbourne as measured by City Mapper, which is an app that takes account of walking, public transport and other modes of transport, basically shows we weren't going anywhere. On to the next chart, of course. Importantly for real estate, of course, is changes to how we live. And on slide 10, I am now. Basically, large changes to how we shop, which are no surprise. I guess in terms of the changes to how we consume, it looked like going online for retail needs was the only option, and that was definitely the case. On the left, the chart shows the spike in online sales for retail penetration, despite the black bar showing retail trade as a whole just basically fell off a cliff and declined. But as the chart on the right shows, as soon as lockdown restrictions were lifted in May, shoppers were out and about, you know, trend just snapped back quite dramatically there. So now we'll get into retail in a lot more detail, but I guess the key question we're grappling with is the extent to which COVID-19 shift to online retail as opposed to in-store will be structural on an ongoing basis, and of course the implications for real estate. Indeed, you know, I know my mum and grandma had never bought anything online before COVID, but now buy their groceries online and have them delivered, and they swear by it from now on. So it's a convenience mixed with health and safety, given, you know, their age and things like that. So that'll continue regardless of lockdown restrictions, of course, but some nuances there that we'll discuss in greater detail. And I guess onto the next slide, 11, changes to how many of us work. And of course, you know, we're using Zoom for this meeting today, and it's no surprise that the Zoom share price has gone through the roof, and that's the teal coloured line on that graph there. Many of us have been fortunate enough to keep our jobs due to them being, you know, a white collar focus and technology allowing us to continue to do our jobs. And I guess having been working from home for the last four months, it's easy to understand how platforms like this one, Microsoft Teams and others have really helped out. Very grateful for technology, of course, in a circumstance like this. If this were to have happened a decade ago, it would have been very difficult. In terms of the implications for commercial office property, of course, there's no doubt some habits will change, and I think the acceptance of working from home will go up dramatically. And of course, the need for physical interaction, though, will remain, and I think we'll see a bit more of a focus on maybe a mix of working from home a few days a week or a fortnight, but then ensuring that people can get together to really get their ideas and collaboration coming through, and of course for bosses to keep tabs on what their workers are doing, which I'm sure is a big one. Onto, I guess, the public markets. Of course, as I'm sure we're all aware, March was a particularly volatile month, and I'm on slide 13 at the moment. So effectively there were blood on the streets across all sectors in March, as we can see with some of those returns there. Each of the major sectors of the domestic equities markets were down, and unfortunately the A-REITs were among the worst performers. As I mentioned, of course, as an asset class where the investment prospects essentially depend on utilisation, movement and a functioning economy, each of those were put on pause, and those three elements were essentially removed for an unknown period of time, and that was the case in March. Since then, we've had a lot more visibility and disclosure and a bit more of an insight onto what implications have been. So A-REITs performed poorly because basically there was concern around the underlying income that was flowing through. If I move across to slide 14, you can see here a bit of an idea of what happened in March. A-REITs struggled across the board, and the sector was down 35% and underperformed the broader equities market by 14%. This wasn't just Australian listed property, it was indeed REITs were down over 22% globally in March. I guess our sector was led down by the larger domination of retail shopping centre stocks. Given their dominance, they had a bigger effect on the market. But, you know, there were unprecedented declines across all sectors. Some of the better performers, of course, were in the industrial and logistics space, and the key underperformers were in that shopping centre space. I'm on slide 15 now. Look, this is an interesting slide, and it just goes to the indiscriminate selling through March. We've got the chart here of two stocks, two that are very, very different. The first is Scentre Group, which is the Westfield shopping centres in Australia, and the second one's Qantas, which is basically an airline and probably the most tethered to travel and tourism and impacted by the COVID-19 restrictions on movement as any, certainly up there with hotels, probably more so given they're not used for quarantining returning passengers and other other means that'll get some money in the door. But a lot didn't make sense. And, you know, I doubt there are only ones wondering why an airline without a credit rating and over 60% gearing would have fallen by less than a shopping centre REIT with one of the highest credit ratings amongst the A-REITs and half the level of gearing. So we thought that was probably an interesting dynamic, and it probably points to, you know, the next slide being number 16, where, you know, it was a different story outside of March, and the sector's rebounded quite considerably from its lows, and outperformance was led in May and by the shopping centre names, which are up about 15%, and of course since then a fair bit of the sector return has returned as, you know, some greater clarity on the government stimulus was a big one. Individual sectors like childcare were fortunate to get targeted support as well, and we got visibility to which companies and which tenants were actually paying rent and across which sectors. On to the next slide now. Look, basically when it comes to REITs, the whole premise is that they've got relatively high yield-based return characteristics with a lower beta. So that's a lower movement relative to the market. And essentially through COVID-19, that wasn't the case. But the beta was still below the market, which is, of course, one. Pre-COVID, the beta of the A-REIT fund was lower than its benchmark and tremendously lower than the market. And of course, we saw that kick up through the COVID period. But look, I guess if there's one belief, and we're resolute in this, is that the A-REIT sector's traditional, I guess, focus on collecting rents and providing a relatively high distribution yield with lower relative risk is likely to return as COVID-19 works through the system and we get on top of things. I guess onto the next section now, I'd like to go through a bit more detail on the implications and I guess the outlook for each of the major commercial property sectors and a couple that are probably in the alternative bucket. So I guess we'll start with CBD office. Look, key drivers have historically been the need for centralisation, corporate agglomeration, transportation, access, and access to a diverse labour pool. While figures for physical use through COVID-19 actually range from, you know, between the single digits to 20%, we understand the majority of corporates working from home, like we are still in a position to pay rent and have been. As a concept, I guess the decentralised corporate office workforce is nothing new. The ease with which many companies switch to working from home probably shows that, and that flexibility, if anything, will be the constant and key through this period. I mean, longer term, a widespread move to for all organisations to work from home on a full-time basis is probably highly unlikely. Indeed, there's been some surveys recently of both companies and workers suggesting that I think 70 to 80% in one survey of all workers wanted to work from home or have the ability to at least 1 to 2 days a week. But a very small percentage, you know, it might have been in the 20% range, actually wanted to work from home full time. So that's an interesting little data point there, and I'm sure we'll get a lot more of a feel for things as we move forward in this. On to the next slide, and now I've delineated between CBD and metropolitan offices. So I'm on slide 20 now, and look, suburban offices have basically taken off in the metropolitan areas, in particular of Sydney and Melbourne and Brisbane to a lesser extent relatively, but basically the metropolitan or decentralised offices are nothing new, and they've basically tried to bring the workforce closer to where they live, so the place of business. They give a bit more depth and diversity of tenants, and are definitely more affordable for corporates. So, for an example, in Sydney, CBD rents are roughly double what they are in a market like North Sydney, Chatswood, Parramatta, Macquarie Park. So for many of these reasons, we believe metropolitan office properties are likely to be perhaps more resilient, especially for the cost-conscious corporate that will still look to maintain an office presence, and may actually need to have a bit more space to combat, social distancing requirements and densification that will have to be unwound. So for these reasons, at this point, perhaps metropolitan office might be not a bad place to get a decent income return, and that's why I guess the COVID indicator in the top right is amber. On to the next slide, and now we're into so retail, and this is the retail discretionary. So this is your shopping centre, your mall, where you'll go and shop for things that you don't necessarily need, more so for things that you'll want. So the discretionary retail look like the largest regional and sub-regional malls. COVID-19 has been particularly tough, with the outlook from here difficult. National, international tenants have the balance sheet to pay rent, but a number of them have just flat out declined the requirement to and effectively pushed their lease obligations on hold. And of course, they're assisted by some protections from the federal government around a mandatory code of conduct and the inability to evict tenants. But, large landlords in the retail space are mindful of the stresses that these tenants are going through and need to work with them for the long-term sake of their assets and their rent rolls. So it's just going to be a difficult time for shopping centres and their investors as we work through this. And the outlook's probably quite weak, and hence the red COVID indicator on the top right there. Moving across to the next slide, though, and at the opposite end of the retail spectrum is the non-discretionary retail space. So this is your neighbourhood shopping centre where you'll go to Woolworths or Coles, Aldi, and do your daily needs type shop. And definitely COVID-19 has been a boon for these retailers, with turnover up in the double digits, people unable or unwilling to eat out. I know personally on the CommBank app that I use for my own banking, grocery's been the biggest source of spend for me and my wife over the last couple of months. And, we're slow cooking and things like that. So where we can't go and eat out and things like that, we've made do with buying more from the supermarket and cooking more at home. And of course, when it comes to grocery delivery, the kicker for that is, of course, that the delivery takes place generally from the local supermarket. So items are picked from the shelf, and the supermarket then delivers out to individuals who have ordered online. So the real estate is actually in high demand, high utilisation, and deriving a fair bit of operating revenue for the tenant, which of course passes on to the landlord and our investors in the form of their earnings and distribution. So the green COVID indicator there really suggests that this segment of the retail market is one that we're favourable on, and where we've diverted a fair bit of our investment for the fund over a long period of time, and will continue to do so. On to the next slide, of course, and another pillar to the retail space is hyper-convenience and fuel. And I guess for similar reasons to non-discretionary retail, another one, of course, is the large developed portfolios in the fuel and specialised hyper-convenience space. And you can see those brands on the bottom right-hand corner. Very well capitalised groups with national and international tenant covenants and long weighted average lease expiry. So it wouldn't be too uncommon for a service station to be subject to a 20-year lease, at least 15, with options of 4 times 10 years, and they've still been doing a fairly decent trade and all paying rent to our knowledge, which is good for investor returns in that space. On to the next slide, slide 24. 24. We've got another sector which is industrial and logistics, and obviously property is likely to perform strongly as a result of COVID-19, especially as goods need to move around a bit more, and as more people look to buy online. Contract logistics, fulfillment, and some segments of the manufacturing sector will definitely benefit, and logistics and industrial warehousing will also continue. Obviously, lockdown restrictions have brought into focus some supply chain issues, and that resilience is really important in a supply chain, where some firms may have held inventory, just in time for delivery. They'll probably hold it just in case, to make sure that if borders close or if lockdown restrictions are rolling in force, they've got the product on hand. So that, in our view, will probably lead to marginal demand in the large scale logistics space, where some tenants will carry more stock, requiring more space. But conversely, with the backdrop of a weakening economy, there might be some manufacturing and industrial tenants who find it difficult. So despite that, we believe on balance, the industrial and logistics segment of the market will be relatively strong, hence the green indicator there. On to the next slide, and we're getting into the specialist or alternative type non-traditional real estate space, but they're exceptionally attractive for many reasons. And of course, the social infrastructure space, in particular childcare, it's basically a nationally regulated utility, I think, as we've seen in the last few months with Scott Morrison basically pulling out the stops and saying that childcare is an essential service and it will get support and parents will be supported. And we can't afford for this industry to be under stress when things open up, because of course it really contributes to the labour force participation rate, and that has a multiplier effect on the economy. So early learning centres in the childcare space are obviously tenants have come under a little bit of stress in the last through the COVID period, but I guess as things sort of open up and the outlook commenced as moderate, it turned more positive after federal government stimulus has been brought in to support operators in that space. And it'll be an essential element of a recovering economy going forward. On to the next slide, of course, another alternative branded real estate asset class is, of course, self-storage. So for the storage sector, the immediate impact, from COVID-19 will be mixed, but on balance, stable. Lockdown inhibits the movement of stored goods, and payment continues for storage facilities. It's basically direct debited by those who use it. There will be weak consumer sentiment. There might be some lower business activity, and business users of storage are actually relatively high and a source of growth. So that may make there to be some pressure on occupancy and revenues from storage. Of course, there is some leverage to the housing market as well for this segment where people move in and out, which might also be a headwind. But the outlook for this sector is, again, considered to be relatively stable on balance, and perhaps marginally weaker. I guess onto residential. We don't have too much of an exposure on a direct look-through basis in our AREIT sector, and especially into the AREIT fund, which aims to basically pass on rent receipts from relatively passive commercial tenants, high covenant quality commercial tenants, of course. So residential is more of a development type function in the AREIT sector. There isn't a build to rent or an established one at the moment. There's some REIT like Mirvac, which is doing some build to rent, but on the margin, it doesn't really make much of an exposure to us. But look, our outlook for residential is similarly for moderate to weaker performance. Dwelling transaction volumes decline when there's little activity. The inability to actually go and inspect a property. Of course, feeds into that, and of course the dwelling completions and development rate is substantially lower. You know, declining economic conditions and consumer and business confidence definitely weighs on sentiment. But you know, interest rates are a tailwind for the sector, and you know they're low and they'll remain low, and financing is cheap for relatively well capitalised and employed borrowers. So that'll be a tailwind to an extent. But you know, on the other hand, we've had population growth across our economy as a large driver of the housing market, and that's all but put on hold, at least from overseas migration. Interstate migration, there might be an extent of that at the margin, but that'll remain to be seen. And of course, you know, government stimulus measures tailored to first home buyers will of course be a tailwind for the resi sector. So on balance, relatively stable. Moving along, of course, I guess just briefly on our AREIT fund, the flagship securities strategy. Look, diversification from highly liquid real estate securities, actively managed, optimising its distribution, its distributable income. Look at the fundamental level, it's a vehicle for getting some exposure to each of the asset classes we've just talked to, focused our investment, of course, to those where the distributable income is likely to be relatively high and growing and stable. The objective of the fund is, of course, to exceed its benchmark on the distribution, and over a 5 to 7 year period, provide for capital growth that's in line with CPI inflation, and provide that with less than market volatility when it comes to standard deviation of returns. You know, we've got a high certainty of return in the form of a distribution, albeit that it's needed to be decreased given this COVID-19 headwind. But you know, it still provides a relatively high rate. And as we move across to the final slide here, the current running yield of the fund is about 6.5%, compares relatively favourably, of course, to its benchmark index of closer to 4.8. And of course, that's a distribution paid monthly. You can see on the left there that it really fits in with our income-focused philosophy, and lower than market volatility with a constant income return is basically what we're targeting to achieve. And pleasingly, we've had some great research reports and feedback with Zenith and the major research houses of SQM, Lonsec and Morningstar, all rating the fund and maintaining their ratings through this period, which is a fantastic vote of confidence. I guess that concludes the presentation. I'm sure there might be some questions now, so I'll just pass it over to Ben if there's any coming through.
Thanks very much, Mark, and thank you. That was a very detailed presentation, but you were able to present it in a very concise way, and I'm sure those that were participating in this presentation and those that will watch it on the website will extract a lot of value from it. So thank you very much. A couple of questions that have come through. One is just if you have any insights into the flow of money in the property sector at the moment. So post COVID-19, is that moving towards industrial over office or commercial? Any comments or observations that you've got from that?
Yeah, sure. Look, excellent question. I mean, probably 2 months ago, in the depths of COVID lockdown restrictions, there was basically next to no transaction activity across any of the sectors. Things did open up though, of course. There were some transactions in the industrial and office space, and even the retail at the neighbourhood shopping centre level, so those anchored by Coles and Woolworths in particular. We are hearing of a few larger retail deals in the mall space, in the inner city mall space. So David Jones are selling their asset, of course, in the CBDs. And I guess over the last couple of weeks in particular, there have been an elevated level, certainly of commercial, office and industrial development and stabilised asset transactions. Interestingly, I was reading something just yesterday that the volume of industrial logistics transactions has exceeded office, the office sector for the first time, which is interesting. And look, it's definitely on the radar of a lot of deep-pocketed direct investors who want an allocation to that asset class.
Thank you. I just, for those participating, if you do wish to ask a question, please use the Q&A box at the bottom and type it in. Just another question in relation to residential. There's been some commentary in the press that the residential property will remain flat until 2025. Seems a fair way away at this point. Do you have any comments on the outlook, and is there going to be a difference between, say, the eastern seaboard and other parts of the country?
Yeah, sure. Look, Ben, I actually saw that same report, and I admit that the headline did jump out of me, and that very well may be the case. I mean, we've had a substantially strong growth in the residential sector over a number of years. Flat to 2025, look, that may be the case. It may be different in different pockets. I know certainly there's been a lesser number of transactions, and I wouldn't be surprised if there is, you know, a relatively muted growth from here on in. Having said that, 5 or so, 6 years ago, I wouldn't have assumed there would be 20% compound growth for a couple of years, certainly in Sydney and Melbourne. So it's a difficult one. When you pair it back to the drivers of that, I think interest rates will definitely help. Sentiment in the economy will help, but population growth will be a factor that will perhaps decline the ability of the resi market in some pockets. But then, of course, there'll be stimulus and support for first-home buyers, and don't forget that there's been a drawdown in supply, and we've had a supply issue nationally for some years. The extent to which that is further muted because of the lack of activity through this could see that demand supply imbalance and prices actually grow. So it's difficult to say, and it'll be a moving feast and market specific.
And just sort of linked on to that, is there any forecasting as to what the immigration may be? Because ultimately, as we have a net increase in immigration generally, that leads to greater demand for property. Obviously, with borders closed at the moment, we wouldn't expect this to be indefinite. But is there any? Do you have any insights in this area?
Sure. Look, what I've read, I guess, has been about declining population growth. So Victoria was leading the charge for a fair bit of time there, probably motivated by its education institutions, and you know, there was great employment growth as well here. So offshore migration was driving a lot of that. Interstate migration to an extent. I saw Queensland was relatively popular from the interstate migration point of view some periods ago. But definitely, I think there'll be, well, all pointers are suggesting that in the short term, at least, there'll be you know, a population decline in that growth rate for sure.
And just the final question, which I always get asked in presentations, and I'm not surprised that it's come up again today. But when's a good time to invest? Yeah,
sure. Look, that's, I guess, the question. The interesting part of it is, and it's a great saying, when the opportunities are there, the capital isn't, and vice versa. Certainly a great time to invest in the A-REIT market would have been towards the end of March. Obviously, the sector's rallied a fair bit since then, but it's still down off its highs. And I guess when it comes to timing, for investors that have a longer term view, and if you take the view that COVID-19 is not going to end the world as we know it, and we will get back to normal at some point, it's really a moot point on the timing from that perspective. So look, for the investor that's after an exposure to the commercial property sector in a liquid form, that looks to get exposure to upwards of 1,000 different individual property class properties. I think on a look through from the AREIT fund in particular, there might be 2,500 to 3,000 individual assets that you get exposure to in a liquid form in the AREIT space, especially now as things, we've had a taste of opening up on the COVID-19 restriction side. Again, it's a tough one, but for those with a longer term view and a focus on commercial property for income, it might be the right time.
Good points. Again, Mark, that concludes the questions. Thank you very much again for your time and that you've taken to prepare the presentation and deliver it for the clients. And I'll just like to, in closing comments again, to thank Simone Newman for facilitating the webinar today. Thank you very much, Simone. You've been a terrific supporter of Orion Private Wealth Management, and it is greatly appreciated. For all the clients, please stay healthy, stay safe, and the office remains working and open. And if you've got any queries about your circumstances or portfolios, please don't hesitate to contact us. Thanks very much, and I'll conclude the webinar now. Thanks again, Mark.
Pleasure.